Hello and welcome to CMS Forex Daily Video Recap. I'm your fundamental market analyst, Nick Nassad. Today is Monday, June 14, 2010. Let's start by taking a look at Eurozone industrial production data for the month of March, which helped to boost the euro as it came in stronger than expected. In April, output rose 0.8% on the month and climbed 9.5% compared to the same month last year, which was higher than forecast, which called for a 0.5% month-over-month increase and an 8.7% annual increase. The annual rise, in fact, was the best year-on-year increase since records began in January 1990. From a look at the internals of the data, we see that the gains were powered primarily by intermediate goods and a rise in capital goods. Energy output was down 0.9%. In the negative, consumer goods, both durable and non-durable, were down. Still, the fact that companies continue to invest in capital goods means they feel confident enough in their recovery to continue buying machinery. What the data implies is that worries around sovereign debt in the Eurozone have so far not derailed the Euro block's recovery. The news helped to power risk-on trades during the overnight session after we had strong gains in the Asian session. From Japan, we saw the BSI Large Manufacturing Index rise 10% for the second quarter, beating out the 7.8% increase expected by the market, and was also higher by 4% if we compare all industry, not just manufacturing. The index measures the percentage of firms that expect the business environment to improve from the previous quarter minus the percentage that expect it to worsen. The results suggest large manufacturing had shaken off fears of the euro debt crisis and the strengthening yen, according to analysts. Firms also raised their capital expenditure plans, which observers said was a sign that corporations were showing greater appetite to spend. Therefore, sentiment is gradually improving both for underlying conditions and the outlook. Taking a look at the euro-dollar pair, we see that the market shrugged off Friday's weak U.S. retail sales release, and right at the onset on Sunday, we jumped above important resistance level of 1.2150, which was our high on Friday, but also had been support earlier in June. We came to a high of just below the 1.23 level, and then we topped off. Now we could see that a good chunk of the increases came following the release of the industrial production data. Now the euro gave up some of its earlier gains as Moody's had slashed Greece's government bond ratings by 4 notches to junk territory. The cut puts Greece's rating to Ba1, which is the highest junk level rating. The ratings agency said there was considerable uncertainty surrounding the timing and impact of support measures on the country's economic growth, referring to the EU-IMF rescue package of loans. Now the euro fell in the wake of the news, but cutting into the gains by only a small amount, and if we take a look from Friday's rally, we see that it was about 1/3 of this full rally from 1.2050 up to 1.23. There are several reasons for the subdued reaction, as Moody's is not the first rating agency to take away Greece's investment grade status. Also, they kept the outlook for the country at stable. Greece, having secured the EU-IMF package of emergency loans, does not need to come back to financial markets anytime soon in order to borrow to fund its budget deficit. And finally, the ECB has said that it would accept Greece's bonds as collateral for new loans no matter what ratings they are assigned. So while it didn't have that much of an impact on the euro, the news did cool the sense of risk appetite in U.S. equities as stock indexes gave up their loftier gains seen earlier in the session, and oil prices paired their gains as well. The overnight rally in risk boosted stocks and commodity prices, as I mentioned, especially oil, which helped propel the USD Canadian dollar to new 4-week lows as it moved in favor of the Canadian dollar, breaking below our support at 1.03. Now we hit a low at 1.0222, and then the greenback managed to pair its earlier losses, moving back to where we had started the session following the Greece news, which paired a lot of oil's gains as well as U.S. stock gains. In fact, by the time we closed, the Dow was actually down by 20 points after having been up to the 10,329 level earlier in the day. So the Greece downgrade does have the potential to bring back risk aversion in the markets, though we didn't see it in the euro dollar case. We did see it on the USD CAD and in the dollar yen. Here we have a look at the dollar yen, which has been trading in a pretty tight range the last 5 sessions or so. We had risen higher overnight until we got rejected at the 92 level, which had been our support. Which had been our resistance back here on June 6th, and acted again as resistance in today's trading. And then after consolidating in another very tight trading range, we broke lower following the Greece news and as U.S. stocks gave up their earlier triple-digit gains. Today's decline amounted to about a 50% retracement of this rally that started back here on Thursday, and with our high in overnight trading today. In upcoming fundamental news, the Bank of Japan will conclude its interest rate meeting tonight and is set to detail a plan to stimulate credit for private companies through a lending program, though that it may be limited to a few trillion yen or a few tens of billions of US dollars, and therefore may not provide the boost needed to get to spur economic growth. The effort by the Bank of Japan is mainly aimed at fending off calls for broader monetary easing, as pressure is being put on the BOJ by incoming Prime Minister Naoto Kan. We'll see if this new lending program will have the effect desired or if it's a small measure meant to placate lawmakers. Other currencies were not really dented by the Greece news, keeping their earlier gains from the rally in risk assets. One of those pairs was the pound dollar, which, moving from 1.45 in late Friday trading, rallied all the way to 1.48, a move of 300 pips, winning back all of its losses that we saw in Friday's session following a weaker than expected industrial production report from the UK. The pound was supported by the general risk appetite overnight and a report by the newly formed UK Office of Budget Responsibility that cut net government borrowing forecasts for the year ending in March 2011 by £10 billion and also by £22 billion over the next 5 years, compared to the figures that Treasury had put out in March. The forecasts were based on market interest rates that have fallen since May because of expectations that the government will take steps to reduce this deficit. However, on a negative note, while the economy has kept its forecast to grow 1.3% this year, the previous forecasts of a 3.25% increase in 2011 and a 3.5% increase in 2012 were cut down to 2.6% and 2.8% respectively. Last week, on around Tuesday, which corresponded to this drop in the pound dollar, we had Fitch Ratings say that the new Prime Minister Cameron needed to accelerate budget deficit cuts in order to protect Britain's top credit rating. It said the UK is lagging behind other European countries in publishing deficit reduction plans as investor concerns over government debt loads increase, that the increase in debt in Britain had been faster than in any other AAA-rated country. The new Chancellor of the Exchequer, George Osborne, is set to outline the deepest spending cuts in the UK since the 1970s in his emergency budget on June 22nd. Another pair that rallied strongly was the Aussie-US dollar pair, which moved above important level of 0.85, which was our resistance for last week, but it was also the top part of this trading range we had for the better part of 1 month. So you can see we moved to the highest we have been since back here on around May 18th. So that was a pretty bullish sign for this pair, and it did give up some of its loftier gains following the Greece news and the pullback in US equities and commodities. In upcoming fundamental data, the Reserve Bank of Australia will unveil its monetary policy meeting minutes from its previous interest rate decision, and that can give traders an insight into the thinking that went into the previous meeting, where the central bank held rates steady at 4.5%. The bank, while trying to assess the damage to the global economy from the Eurozone, has implied that it would like to bring rates higher as strong profits in the mining sector extend an employment boom that has the potential to stoke inflation. Because of the strong employment data and impact on inflation, if the only thing impeding another rate increase was the Eurozone situation, and it seems as though it has not carried over into weaker figures in terms of industrial production around the world, then we can say that the RBA will be more likely to hike rates again sooner than expected. That'll do it for today's market highlights as well as the fundamental releases. Let's take a look at the upcoming fundamental docket. Tonight, UK releases its RICS house price balance. We get the Reserve Bank of Australia meeting minutes as well as the Bank of Japan interest rate decision. Overnight, the UK releases its consumer price index as well as the DCLG house price index. Continuing overnight, Germany releases ZEW economic sentiment, and the Eurozone will post quarterly employment change data as well as its trade balance for April. Tomorrow in the US, we get a regional manufacturing index report, a measure of import prices, long-term purchases by foreigners of treasuries, as well as the NAHB housing market index. From Canada, we get data on labor productivity as well as manufacturing sales. And that will do it for today's broadcast. For more news, videos, and analysis, please visit our site, cmsfx.com. I want to thank you for watching and wish you good trading.